If there is one thing true about investing, it's that two opposite things can be true at the same time. That might sound a bit philosophical, but hang with me for a second. You see, the market can be overpriced and still go up. A company can look expensive and still be a great investment. And sometimes the biggest dangers hide behind the safest looking businesses. In today's episode, I want to talk about this strange but powerful truth. This episode is about how it shapes us, how it shapes the way we invest, how we think and how we make decisions when nothing is black or white. Curious? Let's jump right in. Investing is so much more than numbers on a spreadsheet. It's not just about financials, charts, money, or business models. Maybe the most overlooked piece of investing, the part that often decides whether we succeed or fail, is psychological. See, companies change all the time. Business models evolve. But people don't really change. People behave in remarkably similar ways decade after decade. Greed, fear, overconfidence, doubt. These are things that will always stay with humans. So recently, I've been thinking a lot about contradictions. So let's start with the first one I've been thinking about lately, which is simplicity versus complexity. There is nothing simpler than investing. Really, you could set up an automated low-cost index fund, toss some money in it every month, and not touch it for 30 years. Done. That's it. It's that simple. But at the same time, investing is arguably the most complex game out there. It touches everything we do. Every person, every decision, every part of the world is touched by investing. Investing is about making money, sure, but it's also about solving problems, understanding people, tracking policies, interpreting financials, reading consumer behavior, and keeping up with psychology, patterns, math, history, biology, and science, all rolled into one. In a way, it's the study of everything. And because of that, investing can quickly become pretty overwhelming. It's also what attracts us to the world of investing. It's about continuous learning, a never-ending puzzle, a game that rewards curiosity. That's why the real challenge isn't in finding information. We have more information than ever before. It's about managing it, focusing on things that really matter, focusing on what moves the needle. The trick is making investing as simple as possible, but not too simple, because oversimplifying is another trap in disguise. Some of the best investors preach simplicity. Warren Buffett famously avoids complex businesses and focuses on easy-to-understand business models. He only touches what he can truly understand within his circle of competence, even if this means missing potential multi-baggers like Google. But at the same time, an oversimplified strategy like blindly buying stocks with low PE ratios or price-to-book ratios can lead to bad investments. A cheap stock isn't always a good one. Sometimes it's cheap for a reason. This is a classic paradox of knowledge. The more you know, the harder it gets. The more information you have, the harder it is to filter out the things that really matter. And we are being drowned in information. Most of it completely useless. Now, this isn't to say you should avoid content that's just fun or entertaining. That has its own place, of course. But try to balance your time. Because you only get one life and you can only spend your time once. Everything in life, including investing, is about balance. And that's our North Star at the Dutch Investors. We aim to only share what really matters. Ideas and insights that are genuinely useful, or at the very least, offer a lesson you can walk away with. So if you're eager to grow as an investor, choose wisely, follow the right people, read the right books, listen to the right podcasts, use simple principles to filter investments, and save your energy for the few ideas that truly deserve a deep dive. That's exactly what we aim to do with the Dutch Investors Premium. So we filter through hundreds of companies, dig through the noise, and focus on the things that truly matter. We do the legwork, from financials to psychology, from business models to red flags, and give you our honest opinion. Not to tell you what to do, but to help you make better, more informed decisions for yourself. Because not every stock deserves your attention, and not every idea is worth your time. We're here to help you zoom in on a few companies that could actually move the needle for you. In a world overloaded with complexity, we help you keep things simple, but not too simple. Just clear, thoughtful insights and more time for you to think, reflect, and invest. Because the world is already complex enough, and your investing approach doesn't have to be another one. Alright, let's talk about another famous investing contradiction: cheap valuation versus falling knives. And the phrase comes from a pretty vivid image. Just imagine a chef accidentally dropping a sharp knife mid-air. If you try to catch it on the way down, chances are you're gonna get cut badly. But there is also a chance you just grab it by the handle. Small chance though. It's basically the same with stocks. When people say, "Don't catch a falling knife in investing," they're talking about trying to buy a stock that's dropping fast, thinking it's a bargain, only to watch it keep falling and then fall some more. You've probably heard the saying, "Be greedy when others are fearful." It's one of Buffett's most quoted lines. And in theory, it makes total sense. When everyone is panicking, stock prices drop. And that can be the perfect time to buy. But here's the thing that nobody tells you. Sometimes when there's blood in the streets, it's not just fear, it can be a real wound. And jumping in too soon is how you end up catching a falling knife. Let me give you a quick example. Back in 2008, the financial crisis hit people really hard. Bank stocks were absolutely crushed. Now, if you had bought shares of some solid banks like JP Morgan or Wells Fargo, you'd have done pretty well over time. But if you bought Lehman Brothers, well, that went to zero. So not every cheap stock is a good one. Same thing happened in 2022, when the technology companies dropped like crazy. And some, like Nvidia and Meta, came roaring back. But others, like Peloton or Zoom, just kept dropping because the problems ran deeper. So what can we do with this contradiction? It comes down to a single thing: quality. If a great company is getting sold off just because the market is scared, that can be a golden opportunity. But if a company is falling because the actual business is crumbling, that's not necessarily a bargain. It's a potential red flag, a warning. Not to never buy falling stocks, but to be cautious, to understand why the price is dropping and whether the business underneath still has legs. The difficulty here is that only in hindsight you'll know whether it was a falling knife or an excellent buying opportunity. Buffett's trick isn't just buying what's cheap, like he used to call cigar butt investing. Since he met his best friend and longtime partner Charlie Munger, he started buying great businesses at fair prices instead of mediocre ones at a discount. There's a big difference between something being undervalued and something being worth avoiding. Alright, next one, a bit shorter. And this one is tricky, and it messes with almost every investor at some point. It messes with us too. Perhaps it's the most difficult one of all. On one hand you hear, "Let your winners run," "Don't cut the flowers early," or "Let compounders compound." And there is real truth to that, really. Stocks like Amazon, Costco, Booking Holdings and Nvidia just kept going and are still going. far beyond what anyone thought possible. Buffett is known for saying, "My favorite holding period is forever," which sounds lovely in theory, but only holds true for a very select group of companies. Because on the flip side, holding too long can hurt too. Many great companies have never reached the same highs they did before. Look at Cisco, Intel, BlackBerry, Peloton, Nokia, and 3D Systems. Many had great products, great moats at the time, but one way or the other, they lost their edge. And if you bought them at their peaks, you would still be down on all of them. So holding forever sounds great, but in practice it's very difficult to decide when to sell or when to hold on. So how do you know when to sell? And that's the frustrating part. It's easy to say, "I'll sell when it's overvalued." If you thought Amazon was overvalued in the late 90s, you would have missed one of the best multi-baggers of all time. So what is too overvalued? That's the million-dollar question, really. And I'll be honest, there is no golden one-size-fits-all answer. But here's something that does help us. Having a framework, something you hold on to, whatever happens, and apply to every single investment you make. Include a reason for owning the company in your thesis. If it's solely because of valuation, decide when you will sell. If you buy something because you think it's going to be the largest company in the world 25 years from now, perhaps you never sell, no matter the valuation. Create a framework and stick to it. Because let's face it, great businesses can stay expensive for years. And if there's one thing to take away from all of this, let it be this. Investing is a game of contradictions. And that's what makes investing so extremely fascinating to me. And also so humbling. It's not a science experiment with fixed variables. It's a constantly moving puzzle that blends numbers with narratives, data with emotion, logic with a whole lot of human behavior. Markets aren't machines, they're mirrors. They reflect our hopes, fears, greed, biases, and beliefs, and they test us over and over and over again. The best investors, the ones we look up to, aren't the ones who always get it right. They're the ones who learn to live with the contradictions, who develop a flexible mindset, but stay anchored by principles, who simplify things without oversimplifying them. So, where does that leave us? It leaves us right here, trying to learn, trying to grow, trying to be just a little bit better than we were yesterday. And that's what we do at the Dutch Investors. We know this game is hard. We are not here to say it's easy, but we try to make it a little easier. We help you focus on what really matters, filter through the noise, and spend your time on ideas that are most worth it. Not just the stocks that are exciting, but the ones that actually move the needle, the ones that build wealth, the potential compounders, or the ones overlooked or misunderstood by the market. We don't have all the answers, and we never pretend to. But we do promise to keep asking the right questions, to keep showing up, to keep learning alongside you, and to take you on this investing journey. Because if there's one last contradiction worth embracing, it's that the best investors aren't the ones who act like they know everything. They're the ones who dare to admit they don't know, but are curious enough to figure it out and learn. Thanks for being on this journey with us. Until next time, stay curious, keep learning, and happy investing.